lost everything. Chrissy was talking about your friend there, they lost a lot in the past as well. And I think, that was one of the kind of key things that I learned was that, the skills that I learned through property investment at that time have still stayed with me. But also I've kind of learned from the mistakes that we made at that time as well. And now it sometimes seems like it's more difficult to get into property investment, all the checks that you need to do, especially from a mortgage point of view. But seeing what sort of this financial lending sort of situation was pre 2008, what it's like now, it definitely is better. And what they are doing, it does protect you as a consumer as well. So yeah, I've been investing myself with my wife personally since 2010, and we just started buying cheap properties initially. It's all I could afford. Luckily back then, you didn't have the ADS, the second home tax. You could get mortgages on properties from 40,000 and above. So all I really needed was a 10,000 deposit. I was very much into delayed gratification, read Rich Dad Poor Dad, as a lot of property investors do, and started funneling all my money into property investment, and just trying to keep my overheads as low as possible. And we was just kind of funneling money into property, really just trying to buy one a year, and that was going quite well. And we didn't realize it at the time, looking back now, but that was a great time to invest in property because that was kind of post financial crash. It was very quiet in the property market. Sometimes if you bidded on a property, it's the only one bidding, compared to now, the way the market is, it's obviously a lot more buoyant. And yeah, I was kind of buying properties in the local area that I grew up in, Dundee. The properties there were quite cheap. The rentals were quite good. I've always been able to achieve at least sort of a 10% gross yield in my area. And but luckily, that area started to kind of improve over time, and the properties have increased in value as well. As my property journey started to kind of develop, got to about sort of 2016 time, I had by then probably about six, seven properties under my belt. I was involved in hospitality still, working with the family. I was married by then, had a young family, and I wanted to, transition into a more 9 to 5 job. And because I was so passionate about property, I wanted to do something property related. I went along to a local property meet in Dundee, and I met a mortgage broker there. And even my mortgage broker that I had at the time, he'd been saying to me for a while, look, why do you think about becoming one? A lot of mortgage brokers are older, retiring. There's not that many new people coming into the market. And I thought, well, I can kind of tie the two things together, property investment and sort of advising my clients. And yeah, I decided to train and become a mortgage broker. I became one in 2017. Been running an event in Dundee since actually 2017, all the way up till 2024. And yeah, my strategy's changed over time. Initially started buying cheaper flats, then kind of moved into houses because I wanted to kind of diversify my portfolio. Still in Dundee. For me personally, it's where I grew up. I know the streets, I know the areas. I think it's kind of a diverse enough area. It's got all the fundamentals that you're looking for. So when it comes to like transport, jobs, yield, and everything else. And it's quite a steady market. Some of the other markets have had their ups and downs, but the Dundee market generally has been fairly stable, apart from kind of that sort of 2008 crash. Um, and yeah, so really how I built my portfolio wasn't anything magic. Like we see a lot of people online doing, lots of things. And a lot of my clients do these things, where they get private investors involved. But really, I've never had any private investors myself. It's all been through my main strategy is sort of having a business or a job and funding as much money from there, keeping the overheads low and putting that into property. And I felt like it's like a bit of a snowball effect. It's very difficult at first buying your first couple of properties, but then over time you've got your rental profits coming in, your properties are appreciating in value. You can kind of tap into the equity, and it becomes easier and easier over time. And then it's kind of from there. More recently, I've been looking at buying portfolios. One, because of the ADS now, it's 6%, which is an absolute killer for us up in Scotland, having to pay 6% on top of the property's value. So if you do buy six or more properties in one go, you don't need to pay that. You also get the multiple dwellings relief on top of that. And also, it kind of, you can kind of take advantage of economies of scale, rather than buying one property at a time, you're potentially able to buy six or more in one go, and you can build your portfolio a lot bigger. Usually, you're kind of buying a problem though, because there's been a lot of landlords that are selling up because they've not been able to increase their rents. So often, when you find these portfolios for sale, there's normally an issue, and probably the main issue is yield. The yields are often terrible on these portfolios, but then that's reflected in the price. Normally, you get these properties at a discount compared to their market value. Yeah, as Alan suggested, I'd mentioned, I have actually recently moved. Just about 3 weeks ago, I moved to Dubai. Luckily, property has created financial freedom for myself, my business for Freedom Financial. We generally deal with clients remotely, especially since COVID. A lot of my clients have never actually even met face to face before. A lot of my colleagues moved away through COVID. One lives in Aberdeen, one in Edinburgh. So they're all over. And I got to the point where it's just me and one of the colleague in the office, and I thought I don't actually need an office anymore. I've got very few clients in Dundee itself. They're kind of based all over Scotland. And I decided that I don't actually need a physical location. That's not really kind of benefiting me. And then I went out here on holiday last year, really liked it for multiple reasons. It's a very Marmite place. You either love it or hate it, but I did really like it. So we decided to kind of move out with the family, see how we get on for a year, and then take it from there. But the business kind of, I'm still operating it from here, and it's working quite well actually. Working remotely. Time zone difference is a bit of a challenge, but I get that kind of time in the morning when the UK is not awake to kind of power through all my own work, and then by the time the UK wakes up for me around sort of 12 o'clock, that's when kind of schedule all my calls and stuff like that. So yeah, it's been working well so far. My future goals for myself personally, because I've been investing property now since 2010, at the moment is more to consolidate. I've recently bought a couple of portfolios, and just now I'm going to probably sit on my hands, just see how the market plays out, and potentially start to kind of pay some of the debts off. But then also looking for the next opportunity in the market, which I'm going to discuss in a second here. So I thought I wanted to kind of tell you about some tips that I've seen myself as a mortgage broker, running an event for 8 years, seeing the type of investors that are more successful than others, what sort of traits that they have, and what sort of tips I can maybe give you. And probably what the main one things I would say is treat it like a business. Because like a lot of investment is obviously kind of usually a side hustle for most people. Typically you'll have a job or a business, and any sort of additional profits or savings that you have, you're then putting that into property. But you still need to treat it as a business, and more so now with all the regulation involved. If you don't, that's where I see people get sort of trip up, with things are kind of not getting done on time, and yeah, you're just kind of losing money doing it that way. And another key thing to go with that is just getting organized. There is so much paperwork. This is so admin heavy. The mortgage business definitely is, unfortunately. For yourselves, if you've gone through a mortgage application, you know how painful it is, having to provide, everything under the sun. So if you can be organized, get all your documentation scanned, have everything diarized, either doing it yourself or maybe even outsourcing it to a virtual assistant. The clients that are really organized, and every time I ask them for things, they can send it very quickly. They're the ones that can kind of get through these applications very quickly. The ones that struggle are the ones that aren't maybe that good with IT, and don't have anybody else that can help them, unfortunately. Personally, for me, I found kind of budgeting was really good in my own sort of finances. So I had kind of a savings target. I had read some books on financial independence, and if well, it was called financial independence, retire early. They call it FIRE, FIRE, and it really fascinated me. There was like these engineers in America who were retiring at the age of 30. Because they'd basically got a job and continued to live like a student until they were age 30. And then because they had so much in savings, that was enough for them to be able to retire. And obviously, I've not retired myself at that age, and I don't plan on retiring anytime soon. But some of the kind of the aspects of that I've kind of incorporated in my own life. Trying to have a high savings rate, and then any additional savings that I do have, putting it into property. I mean, going back to around sort of 2010 time, I was younger then. I was driving in a flash car. I thought it was great, and read Rich Dad Poor Dad, and I thought, what am I doing? This is just stupid. Sold that car, invested that into a property, and I've never looked back. And now I'm not bothered about cars at all. For me, financial independence was much more important than sort of flashy items. A lot of people that when I used to run the events, would come, and and even tonight I'm going to be talking about a deal that I've done recently, and they're often kind of over analyzing things. I find sometimes you just need to get into property investment. Your first deal might not be your best deal that you've ever done, but just like stock investing, time in the market is better than time in the market. So I think personally, if you've not started already, the quicker you can start, the better. I mean, you don't want to kind of jump into it without doing your due diligence. But at the same time, if you overthink it, you might never start. So, a big regret that most people I speak to is that they say that they wish they started earlier. But the next best time to start is now, really. So you can't look back, you can look forward. So yeah, if you're overthinking it, maybe try not to, because there's so many different strategies out there. There's in the information age that we're in just now, which is great, but also it can be a hindrance as well because there's so much information thrown at you, you can get overwhelmed. And for me personally, when I go to view properties, I really go with my gut feeling. Is it a type of property that I think would be a good investment? Can I see a tenant living there? So for instance, if it's going to be a property where I can see a tenant's going to be there long term, because we can look at the figures, especially on lower value properties, they might look very good. The yield's going to be high, but is that the type of area that you want to have a property in? Are the type of tenants that you're going to attract going to be the type of tenants that you want? And even if you're hands off, it could still cause you problems, especially if your property is nice, but the tenants in the other properties in nearby aren't so great, then that can also cause you problems. And I've had those properties in the past. I bought a property in a very sort of cheap ex-local authority flat, which I thought was a great deal, and it was a fairly good deal. But had kind of the tenants underneath that were always smoking cannabis, stuff like that. And then my tenant turnaround was just constant, just because they couldn't put up with that. So, these sort of things that you can't see by just looking at the numbers. So I personally try to go with my gut feeling most of the time, rather than just trying to crunch the numbers on Excel spreadsheets. And probably one of the main things that I can learn from the last financial crash was trying to take advantage of the bear market. So like when the market does slow down, sort of like that Warren Buffett saying, be fearful when others are greedy and vice versa. And a prime example of that was COVID. When we first went into lockdown, we didn't know what was going to happen. We didn't know if the world was going to end. But at the same time, I just had a feeling that, things were going to get better, and there was nobody buying property. And I managed to buy four in that time, and they were kind of four of my best deals I've ever bought. So just kind of, looking out for those times in the market, they don't always come up, but if you see that a lot of people are moving away from something, obviously you need to pay attention why they are. But if the fundamentals are still there, it might be worth looking at that time. Because like for instance, just now, interest rates is a big talking point. A lot of people are worried, saying, well, interest rates are so high. Is property investment, a good thing just now? Or even just residential home ownership as well. A lot of people are looking to buy their own home are asking me that same question. But one of the things to consider is that, the market is a little bit slower just now. But once the rates start to reduce down to an acceptable level, you'll see a lot of buyers come back into the market, and that's when you see the prices start to rise again. So, yeah, your mortgage payment's going to be higher just now, but are you having to pay that 10 or 20,000 above home report like you was post COVID, when the market was crazy? So you have to kind of weigh it up. Is £100 per month more expensive, or paying tens of thousands more for a property? So there's definitely kind of still some advantages of a slower market that you can capitalize on just now. A sort of basic tip, but really sort of vet your tenants thoroughly. I've made this mistake in the past, listened to sob stories, and then, had lots of issues because of that. I took somebody on at Christmas time who kind of said that didn't have anywhere to stay, and, would need to stay close to their daughter and, what have you, but it was all just lies, and never paid the rent once. And, sometimes you need to kind of make the mistake once to realize that, never to make it again. So now I always vet my tenants thoroughly. And going back to like treating like a business, everybody does things differently. For me, when I first started out, I did self-manage my properties. I was still in the hospitality trade, and we had a handyman that worked with us in that business. And I basically used to kind of employ him through my property business as well. So he would kind of help sort of manage the tenants, go and do any repairs and stuff like that. Now, actually, my dad works in my business with me, and so he's kind of like my property manager. He's got a van. He, deals with all the tenants, and it works really well for us because we've actually got a sort of small lettings business for our family, and that works really well for us. But if you're not looking to kind of grow a big portfolio, then you should really look at a letting agent as well, because sometimes people begrudge paying that percentage to them, but they can be with their weight in gold, especially when things go wrong. And usually they'll prevent things from going wrong in the first place. And that's what I often see. Clients will come to me, saying that I've got this tenant, I can't get them out, and they won't have the right paperwork and stuff like that. And really, legislation isn't on your side anymore when you go into the first tier tribunal. Luckily, I have it. No, sorry, unluckily, I've had to evict a few people, but never had any issues because all my paperwork's been up to date, and they need to see that you are actually trying to help the tenant out. And if you've not provided them with the right paperwork, the tenant can stay there, longer than you'd like them to. And one of the last things as well, because I've been investing in property for so long, I've seen so many different strategies come and go. And what I'd say is like, try not to chase the shiny penny. I mean, there is some great strategies out there just now that are worth looking at. But at the same time, sometimes things are, better than they sound. And, sometimes people can jump around from one thing to another because, that looks great at the time, but actually, once you start to kind of unwrap it, it isn't that great, and I've seen this time and time again. So yeah, just be wary of these sort of shiny penny sort of schemes out there. So mortgage wise as well, I want to give you a mortgage market update. Um, so the recent Bank of England meeting was that they've decided to hold the base rate at 5%. It was at 5.25 initially, and they dropped it down to 5% now. And a common misconception that a lot of people have is that, well, they've held it at 5%. That means that the rates will stay the same. But really, what you want to be looking at is what their outcome in the economy is. So at the moment, the outcome is fairly positive. Inflation, although it's creeped up slightly, is still in that sort of 2% range, which is good. I always look at what America's doing as well. They've just slashed their base rate by 0.5%, which I think is positive. And most rates nowadays that clients are taking out are 2 or 5 year fixes. So the lenders are then pricing what the rate will be like over that period of time. And if they think that rate's going to drop, then potentially your rate even now will come down. And we've already started to see this. So rates have started to come down even since this last meeting. Although they've not come down too much, and they have fluctuated over the last couple of years, ever since the mini budget, and even sort of, summertime this year, they did go up a little bit again, and then have started to come back down since then. So, although, even myself, I'm sharing a lot of good news about rates coming down, they're still not that great, unfortunately, just now. So, if you are getting mortgages in limited company, so just to give you an example of ones without any arrangement fees, you will see some headline ones with very high arrangement fees at lower interest rates. But just kind of give you a comparison just now with no arrangement fees for a 2 year fix, you're looking at something in the 6% range, and for a 5 year fix, you're looking around 5.5% just now. So that's for a 75% loan to value mortgage. In personal name, if you're still investing with buy to lets in your personal name, you're around 1% lower than that just now. A common misconception like clients kind of ask me about is, well, how much do I need to earn? Do I need to earn 25,000 a year? And generally, if you own your own residential property, then income isn't an issue. A lot of self-employed clients, limited company directors, will pay themselves a minimum salary, usually sort of 12,500 a year, to keep them under the tax threshold. That's absolutely fine. You could be earning less than that. You could be earning no income whatsoever, and there'll still be buy-to-let options available to you. You could be a full-time property investor. Again, there'll still be lending options available to you. The good thing now is that even a lot of mainstream lenders have opened up to sort of this no minimum income criteria. So it used to be a thing before where people said, you need to have a job to get a mortgage. That isn't the case now for buy-to-let lending. For residential mortgages, yeah, you do, because they need to see that is your personal income going to cover the mortgage until your mortgage end date or your retirement. But for buy-to-let mortgages, because it's generally based on the value of the property and how much it's going to rent out for, that's what they'll base their lending on. And the reason why they'll work out what it's going to rent out for is the lender will do a rental, what's called a rental stress test. So when they value the property, and they give a rental figure, it's the value that goes out that will give it the rental figure. They'll use that to do the rental stress test, which has to make sure it covers the mortgage plus extra to cover any voids, tax, and then not just at kind of the rates you gain just now, but potentially a high interest rate in the future, especially if you're taking a 2 year fix. Usually they'll stress test it at around 8%. If you're taking a 5 year fix, the stress test is usually a bit lower, normally at the pay rate, which at the moment is around 5.5%. So yeah, that's generally how they'll kind of underwrite the mortgage. And another question a lot of people ask is like, am I too old to get a buy-to-let mortgage? 'Cause I'm maybe getting close to retirement. Again, buy-to-let lending isn't based on your retirement age. So mainstream lenders will usually go to around 80, or sorry, age 80 or 85. But we've got a lot of specialist lenders that'll go, well over 100. So you could be kind of, past your 70s and get a 35-year mortgage if you wanted to. And the rationale from their point of view is that if you was to pass away, you put in 25% equity in, so their security isn't really at risk. And because it's an investment, you're not living in the property, so they're not, then having to kind of evict you if anything goes wrong. A couple of bits of news in the market as well. If anybody has any Shawbrook mortgages that are coming up for renewal or maybe on standard variable rate, they do now allow product transfers. Shawbrook is a kind of more specialist lender, mainly sort of commercial lending, but just very recently, over the last month, they do now allow product transfers, so you can do a seamless sort of refinance with them without going through the underwriting or valuation process, which is good news. If you're operating a buy, refurbish, refinance strategy, then there is a 6-month rule which came in post 2008, where most lenders require you to have owned the property for 6 months before you can refinance that, and that can be whether you owned it through cash or with a mortgage. But if you can sort of demonstrate that you've added value to that property, there are lenders out there that will allow you to refinance within 6 months. If you're again lending up in Scotland, you've got about 6 lenders that will do that. And ideally, you're looking for an end value of above 75k. And all they'll do is they'll ask for a schedule of works, just outlining what you've done to the property. And this can just be like a Word document or an Excel spreadsheet. And they'll also get the value to confirm that you've added value. So let's say if it was a property that you bought for 60,000, you've done some work to it, it's now worth 80. You could refinance that based on the 80,000 at 75% mortgage within the 6 months. And I've got a lot of clients that do this where they've got that one pot of cash, they'll use that to buy the property, and then we can get the mortgage process started whilst they're actually refurbing the property. There's no need to have a tenant in place when you're refinancing it either, because the value of themselves will determine what the rent will be, and then that allows them to kind of get the money back out and go again. So yeah, it just basically recycling your money a lot quicker. And obviously, we're talking about the Highland property market here. I've got a lot of clients in the Highlands that are investing in holiday let properties, service accommodation, whether that's for tourists, for contractors, or a mixture of the two. How holiday let mortgages work is very similar to buy to let. For most lenders, they'll base their lending on a buy to let basis. So when they send the valuer out, they'll do the buy to let rental stress test. The rationale from a lender's point of view is that, well, if it doesn't work as a buy to let, does it still wash its, sorry, if it doesn't work as a holiday let even, does it wash its face as a buy to let? And if it does, we'll give you the lending. Unfortunately, they do charge more for that. So generally the rates are around 1% higher for a holiday let mortgage. There's no need for you to have any prior experience. The property itself doesn't need to be a holiday let at the moment for you to get lending on that basis. There's a couple of lenders out there that will lend based on sort of the holiday let figures, and this can work quite well for high value properties. So let's say if you've got a house with 300,000, which will do really well as a holiday let, but just isn't going to make sense as a buy to let, with rent might only be 1,200 or 1,500 pounds. It's not going to fit the rental stress test. We've got some lenders who can then accept a holiday let management company's estimation of what it's going to rent out for, and then they'll underwrite it on that basis instead. So you've got a few options here when it comes to holiday lets. In regards to licensing, licensing isn't a thing yet in England and Wales, so most of the lenders are applying those rules at the moment. However, there are a couple of lenders now that if you do have a holiday property and are refinancing it, then they're requiring you to have the license in place. So just bear that in mind. Obviously, with it being in the Highlands as well, there are some postcode restrictions. So just bear that in mind, and it's worth kind of maybe running it by me or another mortgage broker before you're offering on properties. Unfortunately, there are some areas of Scotland where lenders still don't lend. Some of the islands, unfortunately. So Isle Skye is a big one that I've been trying to push for, because a lot of lenders ask me, what would you like criteria wise, and because we do so much lending with these companies, we do get a bit of a say in where they're going to develop their products. And definitely Isle of Skye is one where I get a lot of inquiries, but even like Shetlands and stuff like that as well. But there are some postcodes restrictions in the mainland as well, so that's something to be aware of. Some of the IV postcodes, AB postcodes as well, so just be aware. Sometimes it can be generally sort of more the rural areas to be aware of. Um, Oh, yeah, sorry. So yeah, so I wanted to discuss how to buy tenant portfolios, and I talked about my strategy at the moment, and what I'm doing. This is basically what I'm doing at the moment. So, the good news is that you can get bridging finance, which is short-term finance, up to 90% of the purchase price. So usually when you get in a mortgage, it would be 75% is what they would lend, and you'd need to put a 25% deposit down. But if you can buy a property at a discount, and the discount's high enough, potentially you can get lending over and above the 75%. They still need you to have some skin in the game. So that's why it's only up to 90% loan to value. You might see 100% lending, and where that is obtainable is through your background properties. So let's say if you have a residential property or some buy-to-lets in the background that aren't leveraged too much, so they've got less than 70% gearing on them, then you might be able to take out some additional borrowing on those properties to top up that extra 10%, and that way you can get 100%. You could even get more. I've had clients that want additional borrowing to be able to refurb the properties. The rent will cost if you're buying a tenanted portfolio, the rent will cover the cost of bridging. Bridging unfortunately is more expensive. As a rough rule of thumb, it's going to cost you around 1% a month. So, if you're getting borrowing of £500,000, 500,000, it is going to cost you 5,000 a month, so it is quite steep. But hopefully the rent that you're getting in will cover the cost of bridging. And then, as I said earlier on, you can refinance within 6 months. So if you're doing some works to these properties, then great, you'll be able to refinance it at the market value. If not, you might have to hold on to it until it's been the 6 month anniversary, and then you'll be able to refinance it, and hopefully you get the uplift in value because you bought it at a discount, and then that can then pay off the bridging finance. So it's a great strategy that a lot of my clients are implementing just now. With bridging finance as well, that can be used as a combination of the finance itself plus either your own funds or also investor funds as well. So I do have some clients that take 100% finance through a mixture of those, where they're not actually put any of their own money in, bought a portfolio and then refinanced it and then paid their investor back, and they've basically got an asset without actually, putting any of their own money in. So I wanted to kind of discuss a deal that I've done recently. So this was 9 properties, although there's only 7 here on this page. In my local area where I grew up, so I know it very well. And it was actually offered to me at market value initially by a sort of a local estate agent. They didn't want to put it on the open market because the landlord wanted it to be a discreet sale. So they basically just offered it to some serious buyers, and it wasn't really a deal for me at the time because at market value the rents were really low. I mean, some of these properties they were worth about 70, 80,000, and the rents were like 300, 330, so really low. I mean, the yields were terrible. So initially I sort of dismissed it. And then it wasn't until like sort of 3 months later, then the sellers became a bit more motivated, and then I revisited it at that point, and there was a few people interested at the time. So the reason why I chose a portfolio was there was a significant discount. So it was initially valued at I think 670, and then eventually managed to buy it for 525. So I managed to get quite a significant discount on the technical sort of market value. And there was cash flow from day one because all the properties were rented out, although on low rents. But at the same time, you are buying a problem here, and that was kind of factored into the price. Luckily, the tenants were all good. It was one of those sort of situations where there were sort of good tenants, bad landlords. I mean, the landlords were decent people, but they didn't really treat it as a business. So, the paperwork wasn't up to date, the repairs weren't up to date, stuff like that. They weren't doing things properly. And significant savings on the land and business transaction tax, and also the additional dwelling supplement, which is your 6% one, and obviously the main one just now. If you know Dundee, so this was in the Stobswell area, again where I grew up. A lot of regeneration happening just now. So like down at the waterfront in Dundee, they've announced that we're going to get the Eden project, which isn't too far away from here. So again, like in most kind of cities, the East End is kind of an area that's slightly more deprived, and that's definitely been the case here. But I do think in the near future there's going to be a lot of sort of gentrification, as they call it, and the values will rise in the area. And again, I grew up there, so I know it very well. So the issues with the portfolio, again, like I said already, so the landlords went up to date with the regulations, so they were kind of sold as seen, unfortunately. A lot of the properties didn't have EICRs, gas certificates, stuff like that. I just had to kind of accept it as it is. That was factored into the price. The rents were really low, and that was kind of something that we had to discuss with the tenants when we took on the properties. That like you've had it good for a long time. Unfortunately, we are going to have to increase the rents, and I've tried to keep it fair. So I've only been trying to increase the rents by sort of between 6 and 12% a year. But now with legislation the way they are, I'm going to basically sort of increase them every year. And as and when the tenants leave, then we'll upgrade the properties and potentially refinance them and take some of my equity back out. But we're going to be renting the properties as is. So here are the numbers. So yeah, the market value was 678. And the purchase price was 525. So including all my costs, it came to 537. I mean, it's a big thing to focus on here is the LBTT. So if you was to buy one property for 525, you'd be 6% on that plus your regular LBTT, which would probably be close to around 40,000. But my LBTT, including the multiple dwellings relief, sorry, only came to £3,687. So a significant saving there. 30,000 just on the ADS alone. So it's a great strategy if it's something that you can implement. I took bridging finance at 75% of purchase price. I could have took it at a higher figure, like what I mentioned in the previous slide. One of the main downsides to that, though, is that usually they'll need to value the properties. And for this one, I did promise them a quick sale. So I said, look, I'll be able to kind of do this very quickly for you. And with this bridging lender, they would lend on 75% of the purchase price without actually having to physically value them. And what they do is they'll do a desktop valuation, punch the numbers into their system, and if it passes like their confidence rating, they'll lend without actually having to view the properties. So that was one of my negotiating tactics. That look, I'm a serious buyer. I'm going to complete quickly, and that was one of the reasons why they accepted my offer over some of the others. So yeah, I mean the monthly payments are very high. £3,346. My current rent is 3,900. So cash flow is terrible here. I completely appreciate that, but ultimately I've been able to buy myself a decent asset. I am working on refinancing the properties at the moment. I've got 3 mortgage offers through already, so that's going to bring those monthly payments down. And then the other 6 properties, I'm going to refinance them once I've owned them for 6 months, and that'll bring the monthly payments down even further. So as you can see, the monthly payments will start to reduce. And also, I've taken a lot of my money back out. But at the same time, what I've not kind of factored in then, well, the rents, after the increase are going to come up to 4,200. But then each year they'll continue to increase after that as well. So my cash flow will continue to increase every year. So it's kind of a slow burn. This one, it's not kind of money in, money out straight away. But I quite like these deals, where you kind of slowly work on it over time. So yeah, that was actually all my slides, to be honest. I'm quite active on social media. If anybody wants to give me a follow on there, I try to post daily. I try to kind of hopefully make it valuable content. I'll do kind of blogs, videos, articles. Lots of different types of things. I'm on the main sort of platforms I'm on is Facebook, LinkedIn, and Instagram. And yeah, if you do have any questions in regards to kind of mortgages or property investment in general, feel free to reach out to me. You can go onto my website and book an initial call with me, which is free, where I can discuss kind of strategy, stuff like that. I would say that's kind of one of the main things that people like using me for is because, like I said earlier on, I'm kind of also doing the exact same things as you, so I can kind of, look at your strategy and give you some tips. Although I'm not a financial advisor, I can kind of tell you what I would do if that was me in that position as well. So yeah, happy to have a call with any of you guys, on the follow up as well. And thank you very much for listening to me today.
Awesome. Excellent. Thank you very much, Kesar. Appreciate that. We're going to open the room for a few questions, and I know Sam already posted one on the chat. And the question for you is obviously we thank you first for your for sharing all the knowledge and your journey as well. But how do they calculate the buy to let mortgage? Sam is asking if you can clarify that.
Yeah, is that the rental stress test?
Yes.
Yeah. So the estimated monthly rent, of which you're not going to know exactly until a value goes out to value the property, but you'll have an idea of what you think the property is going to rent out for. So let's say if it rents for £500 a month, If you multiply that by 12 to give you the annual rent, so that's 6,000. And then this is where it gets a bit more complicated. It depends how you're investing, whether it's in personal name or limited company. But as a limited company investor, you then divide that annual rent figure by 125%. So that's your interest coverage ratio. The extra 25% is to cover your void periods and tax. And then you divide that figure again by the stress test rate, which might not be the rate that you're being offered. Generally, I'd advise most clients to base it on 8%. So let's say you've got the 500 rent, multiply it by 12 to give you your 6,000, and then divide that by 125%, and then divide it again by 8%, and that'll give you a figure. And that figure will be the maximum amount that they'll allow you to borrow. And then, so let's say if you're buying the property for 100,000 and that figure is 80,000, then you'll be able to get a 75% mortgage because you can potentially get up to 80,000. If that figure came back and is 60,000, then you've got an issue and potentially you'll only be able to get 60,000 of borrowing. So you need that figure to exceed 75% loan to value.
Awesome. Sam,
Hope that makes sense.
yeah. Well, Sam is on, so he can just answer or see if the answer is correct.
Yeah, that was great actually. So actually they will look at the rent first, isn't it?
Yeah, both. I mean, the value of the property is obviously important as well, but yeah, definitely the rent is also important. What I would say though is that for most properties under 150,000, you will fit the rental stress test. It's when once it gets over that, because like the rents don't generally increase in line with property values. So if you're buying a property for 200,000, the rent's not going to be double what the rent is for say a 100K property. That's where you might have some issues. But
And
again, there's ways around it, going for a 5-year fix or going with certain lenders that have a more favorable stress test as well.
do they have problem for mortgage below 75K still or not?
Yeah, there's less lenders available below 75K. So, yeah, your options are more limited, but there's still lenders available in that market. So you've got about 4 or 5 lenders below 75K. Below 60K, you've got even slightly less lenders than that, but you still got a couple of mainstream companies. So I've got a lot of clients that buy kind of properties, and actually there's even lenders below 50,000. So I've got some clients that buy sort of cheaper properties, maybe even to try to keep it below that ADS threshold of sort of the 39,999. There are lenders available in that space, but then you're looking at quite expensive mortgage rates, sometimes around 7.5%, 8%. But from 50K and above, you've got mainstream lenders, and then above 75K, you've got pretty much access to the whole market.
So I will contact you personally to see some of my property. I need to get mortgage actually because I bought most of them in cash. So I need to start getting some mortgage on it. And all of them actually is in Aberdeen.
Okay,
So,
yeah. Yeah, no, happy
so
to do that. Yeah, so if you want to go to my website, you can book a call with me and we can discuss it further. It's not a problem. Yeah, I'd love to
yeah,
help.
brilliant, brilliant.
Awesome.
Thanks, Sam.
Thank you.
Anybody
Cheers.
else has any other questions for Kisar? If not, I have a few.
Well, definitely. I'll ask a few as well, Christian.
I'll ask one. What will be the advantage or disadvantage if you wanna share that with our audience today of buying as a limited company and buying as an individual?
Yeah, obviously multiple things. Often we don't think about it initially. I would say inheritance tax planning. So, although I'm not a tax advisor, but we don't think about death really when we're buying properties, but we really should, or just passing it on to our loved ones. So, from an investment point of view, looking at a limited company, often people are buying properties to then pass on to their loved ones in the future. It might be kids. So, through a limited company, you can potentially add them as shareholders in the future, and then eventually pass the business on completely. In personal name, that's a lot more difficult to do. It then kind of it can cause you sort of inheritance tax issues as well. But apart from that, I would probably say just sort of personal taxation. The rules have changed now. If you're a high rate taxpayer, it's not as beneficial to own properties in your personal name compared to a limited company for certain clients anyway. So there's pros and cons of both, because in a limited company, you're paying corporation tax, but then if you want to live off that income and to then extract it out of the company, then you've got to pay sort of dividend tax as well. So it's not always better. You know, it depends on your personal circumstances, but often there's more things that you can do with property in a limited company. The stress test that we discussed earlier on, so like the figures that I gave you, it's 125% in a limited company, but the lenders apply a higher stress test if it's in your personal name because they know that your tax will potentially be higher as well. So that interest coverage ratio, they do that 145%. So for you to get the lending that you need in personal name can sometimes be more difficult as well. So yeah, there's multiple factors. But at the same time, in personal name, the rates are slightly cheaper. Sometimes if clients maybe only have one property and the earnings aren't so high and they want to live off that rental income, there is some benefits of actually owning the property in your personal name because you're just paying the tax once and then it's yours to spend as you wish. Whilst in a limited company, you've got additional costs. And then if you want to extract it, you know, you've then got tax as well. So pros and cons on both sides. Definitely something that you need to speak to sort of an accountant about, but not just about, you know, what your initial property, what your sort of overall goals are. So ideally, you want to kind of give them the figure of properties that you have in mind, and you know, try to be honest with them. You know, say, look, if I want 10 properties, what's going to be beneficial? Because like, you know, if you have only one at the moment, personally, it might be fine, but that might cause you an issue in the future once you do get to 10. So yeah,
Yeah.
speak to an accountant for definite.
Yeah. And one more before I pass you to Alan. With one, because lots of people are joining now from, joining as a limited company or anything. When you purchase through a limited company, is the lender actually looking you as a limited company, or is he actually going to do the stress test on you as a personal, as an individual as well, as a director, obviously, because you're part of it?
Yeah, it's probably the most common question I get, really. So a lot of people are worried that, oh, well, I've just opened a limited company, it's not been trading, so how's that going to work? So the best way to view it is just like a tax wrapper. They are still assessing you as the shareholder and director. So, you know, whoever's the shareholder in the company generally, especially if you've got over 20% shareholding, they are going to underwrite you guys. So, you know, they're going to do credit checks, they're going to look at income. But like I discussed earlier on, you know, that's kind of secondary, but they still want to make sure you are sort of credit worthy. So they're not just lending purely on the limited company. So because I've got some clients that will say, well, you know, my credit history is not so great. What if I do it through a limited company? They're going to overlook my personal situation, but that's not the case, unfortunately. The advantage, though, from that point of view, is that you can set up a company today and get lending straight away. All you really need is the company to be set up, and then you know to get a bank account. You do need to give a personal guarantee. So a limited company, from a tax point of view, you've got limited liability. But unfortunately, for most lenders, they do require you to put a personal guarantee down. So if it does all go wrong, they can come after you personally. The chances of that happening is very unlikely because they're doing all these stress tests. You're putting in 25% of your own deposit and stuff like that. But potentially, you are liable for that mortgage as much as the company is as well.
Yeah, no, thank you. Well, I knew that. I'm just asking more for the people in the room and the people
Sure.
online.
No,
Alan,
that's a great question.
Kesser, what a presentation. Thank you again. I've got a
Thank you.
question for you. In the last 4 years alone, we've had COVID, we've had a cost of living crisis, we've had high inflation rates, we've had high interest rates, we've had high mortgage rates. Have you found or have you experienced a lot of customers that have got into really difficult financial situations, almost to the point of repossessions? Because I look
Yeah,
back in 2020 when COVID happened, I thought to myself, if ever there's going to be a time, there's going to be a property crash, this would be it. And what happened? The exact opposite. But I myself, I've not heard of many repossessions in my area, for example.
yeah. I mean, so what I would say is, as a broker, you know, my market is a bit skewed because it's mainly sort of property investors who have surplus sort of disposable income to invest in property. So I'm not really kind of seeing those sort of applicants. But yeah, you're right. You know, there isn't that many repossessions, to be honest, on the mortgage side of things. There's a lot of protection in place. So at the moment, we've got a mortgage charter as well due to the cost of living crisis. So, you know, people can get interest only payments for 6 months. They can get their term extended without any additional underwriting up to the retirement age, and that's the declared retirement age. So there's a lot of protection for the consumers in place just now to stop any repossessions happening. I have had some clients that have kind of struggled financially. They bought these properties at very low interest rates. Everybody can remember sort of post-COVID, people were buying kind of these £500,000 houses, especially in Scotland, which wasn't really a thing before, because they were more affordable to them, and are now struggling because the payments have almost doubled. So we have seen that, but I haven't really seen repossessions, to be honest. But I do speak to lenders, and I speak to kind of like the sort of adverse lenders. They've been telling me that sort of consumer debt is at the highest levels they've ever seen. So, credit cards, car finance, stuff like that is the highest we've ever seen. So, yeah, it'll be interesting times ahead, to be honest.
Cool. Thank you, Kaiser. Anybody else would like to ask a question?
Very quiet audience. I will open up the breakout rooms if anybody wants to have a chat directly. And I put 3, so feel free to just go on any of them. I will open the rooms now, and you can join, or you can tell me, look, I want to be connected with this directly or with anybody else. Feel free to just join in, and I will stay here just to make sure that we don't do exactly the same thing happened last time when I left and people were stuck in there. And well, I didn't left. I just joined one of each room individually to see. So I'll join in from my phone to make sure that everything goes right. Okay.
Perfect. Thank you, Christian.
Okay, so I'll put you on the Highland one.
Sorry, are you with us just now, Christian? Yeah.
Yes, I am. I'm just waiting for people to actually join in, so feel free to join.
Sorry, Christian, I went into one of the rooms before you said something. You was going to put me in a room, sorry.
Fine. You can just join whatever you want. I will just put
I
everybody.
was going to join the property room then.
There you go. Awesome.
Hello.
Are we all in one main room now, Christian, or is it
I'll
we
put
split
you
up?
all on different ones.
We in different ones?
Who am I?
Pauline, I am looking at you right now.
How are you?
You're center stage.
Oh no.
Not anymore.
Pauline's been dumped. Is she off the screen? I'm back to Christian now.
Well, I'm trying to move, but you need to accept. So
I haven't got a clue, mate. Thank God you're doing this and not me, mate.
networking. Alan, I'll put you to the other one because I think Longchen and the other guy Sams are not doing anything. So
Who are these guys here? Do you know them? No.
probably just from the
Okay,
Facebook.
so
So you want to join? I'll put in with
someday I know.
property. Yeah, to Kesar. Just accept that, okay? Oh, there you go. We're back in business. Yeah, I'm just about to close it, but thank you again for your time, Kesar. And I'm sure that I'm going to send a few people towards you because I know quite a few. Although this is something that I do on the side. Well, on the side, I do both things. Property, Braveheart Property Group, it's my property network, but I also
Hmm.
do the business coaching and development. So
Okay.
depends where I'm going. That's what I do. But I know lots of people looking now to buy. That's why I ask a
Sure.
few questions for me, but also more for the audience because people sometimes like I don't know what to ask. So
Yeah, that's great. You asked the questions. Yeah.
and I know somebody's right now is looking to buy, but he's not very sure if which one is the best option. So I think coming from you directly, probably gonna put him at ease because it's kind of backtracking when he gets hit all this. So 6% in this and pay that and pay that.
Yeah.
So I'm gonna put his details, well, your details across to him and
Okay.
get that sorted because it will be a shame just to back down when I know he has the potential to make more money rather than just put 120,000 in one property cash and
Yeah.
waste it rather than anything. You know,
Okay. No, that'd be great. Yeah, I'd love to help. Thank you very much. Yeah,
awesome,
thanks for giving me the opportunity tonight as well.
great. No, thank you again, and I'll speak to you soon.
All right, Christian. Take care.
Yeah.
Bye.
Come on, let me.